Pennies Going in Raw is a production of iHeartRadio. The opinions expressed in the following podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security or investment product. It is only intended to provide education and entertainment about the financial industry and the stock market. Enjoy!
On this episode of Pennies Going in Raw, we discuss lifestyle and previously crowded plays.
You find out life's this game of pennies.
Oh, you guys know we only have a 40% runner. Hello, 40% is a fucking killing.
We've been compliant for too long. It's time we go to war.
I don't have a Roth.
Hugh knows so much about the market that his brain doesn't have enough room for grammar.
Hey, who told me about IDEX? It's going up a shit ton now.
Rob, 4%, baby. No way. 4 fucking percent.
You asked the exact same question with 2 words different.
It's like, man, I just got dick whipped for like 20%, and now that f***er's up like 50.
I bet Warren Buffett never did that.
I'm just making this voice memo to call out unusual whales to a fight. The pennies we need are everywhere around us.
Pennies going in raw.
Featuring Dan, Deity Dips,
And Hugh, honey.
Produced by Vinny.
And Christian.
Let's go, baby.
Welcome back to another episode of Pennies Going in Raw. Today is Sunday, March the 13th, and we're seeing the same thing from SPY still. Seeing the same thing from Bitcoin, although it seems kind of like less momentum towards the end of the week still. You're seeing these lower lows. Is there much to feel excited about for the upcoming market? Like, it doesn't seem like we're about to get hot.
Yeah, well, I think the best way to put it is if we break it down, it's funny when I think about it. When we break it down, we are in the middle of an invasion of a superpower has invaded another country. And from an economic standpoint, inflation's at a 40-year high, and the Fed is supposed to be tightening. Is supposed to be tightening during this time, and basically stop the 80-mile-an-hour bullet train and reverse it. And I know we talk about this a lot, but it's just like it kind of brings me back to like March 2020 when I was like, this is history being made. Again, this is history being made. Both of these catalysts are huge, and my kids, Dano's kids, your kids are all going to be learning about this shit in 20 years, and we're living through it. And so I think in the moment, we don't really understand the magnitude of what we're going through. But when you think about it, I mean, let's take Friday, this Friday, March 11th. The market gapped up because Putin said that there was headway being made on peace talks. This is the day after, it basically said that that Russian forces are only a few miles outside of, I'm totally going to mess up this name, but Kiev. Am I saying that right? Kiev?
Yeah, I actually have no idea on this.
But so my point is that it's like 1 minute, Russia is invading and about to take over, a large city. And then the next day it's Russia,
I feel like they're in too deep now. You can't really what? Yeah. I don't think Putin's getting anything out of like the peace talks going. What are they going to say? Okay, you can have Ukraine. Like, that's the only thing you'd be like okay with.
Yeah. Well, so that's the thing is that the market. So the market gaps up on Friday.
Yeah, because so by the end of the day, yeah, we're back and then to by the end we're red.
We're down 1,000. I mean 1,000. We're down a percent plus. Like by the end of the day, that's wild. Like we are moving so much right now.
Yeah, if you look at the chart on March 11th, I mean, you see it just open up. It's just like a slide down.
It's just a slide down. And the thing is that, like, yeah, if you capture that move, fantastic. But in the same token, if Biden or somebody else comes out and says that Putin and Biden are meeting, the market will instantly be up 1%. Like you won't even have time to cover your short. So this is where it comes back to, we are living through history right now. And obviously we're always living through history, but this is something that we're going to look back on and be like, no wonder everybody said that Hugh looks tired. Because it's literally like the market's moving 100, 200 points on nothing. I mean, 200 points. It's moving 500 points on nothing, on a few comments. And so I think, when we think about it, it's good to take a step back and really kind of smell the roses, but from a perspective of like, let's just get through this. Let's just get through this. It really feels like the market's inside a holding pattern. And I think there's really two ways that this goes. Obviously, yeah, up and down. But there's two ways that this goes. Either, obviously, this Wednesday, we have probably the biggest Fed announcement since probably the Great Bazooka of 2008. And for anybody that lived through that, or I guess, anybody that traded through that, I didn't trade through that.
Everyone except 10. Our listeners under 14.
Yeah. Literally, like, it's basically like when Paulson went and asked for the bazooka or the blank check. That this is kind of like where we're at. Like, this is like the pivotal spot. If we raise 50, 75, we raise 100 basis points on next Wednesday. Oh, golly gee. I mean, we could like limit down. Because again, when you look at the balance sheet,
I mean, we are rapidly approaching the low of 407 without that.
Exactly. And so you flush that support from a technical standpoint, and
even from like a human standpoint of the 400, I mean, you.
Exactly. And then again, we talked about this a few times, but when you look at economic waves, or let's even talk about 2008. Okay. The initial shock or the initial drawdown of the market is from the economic, I don't want to call it disaster, but economic catalyst. Then what ends up happening is everybody with their 401, and this is something that I want to beat into everybody's head, is that when 401ks start to get liquidated because people are so scared to lose everything, because again, if you live through Black Monday, you lived through the .com bubble, you saw your 401k go down.
Well, that's not just retail traders. That's people who's had 50 years of every paycheck going in.
Every paycheck. And so when they start to get worried and they're calling their financial advisor and they're like, get me out. I don't care what the fuck you do. I want to be cash. That is when you get a run on the stock market.
This is the bottom, dude. It goes up from here, man.
Yeah, well, that's the thing. And then you add in, everybody looked at their 401ks over last year and it's like, holy hell, baby. Like, let's go. Over the last 16 months, they've doubled from where they were. I mean, depending where you are, but most 401ks have had stellar, obvious returns inside the last 16 months. So when you think about that and things start to slip back down from, let's call it their all-time highs, that's when, and you start to get a run on the market. That's what causes the true domino effect of like, you can see the market down, you see the market limit down.
You think if we see it limit down once, we see a limit down again, like how we usually, like I say usually, like it's something we see all the fucking time.
Well, that's the thing. That's the thing. That's the whole thing.
We don't have much of a basis on what happened prior.
Exactly. No, you're literally, you're completely on point. And that is why I think it's so important that part of this episode is about lifestyle, because I would love to sit here and spew out a bunch of research and backup data.
Yeah. It's the last 6 times the market crashed. And if we go back to 1909, you can see.
Exactly. And even if you go back to the Great Depression, we have pumped more money into this market in 20 months than the entire existence of the market. That's wild. That is truly incredible. And I know I'm kind of nerding out right now. And everybody, I know that my mom's going to listen to this and be like, so, but that is crazy. That's truly insane. We've doubled.
Yeah, no, listen to this. Money flow into U.S. equities. 2002 to 2020, $279 billion. In just 2021, $413 billion.
That's wild. I can't stress this enough. This is truly incredible. We've never seen this before. And obviously we've never seen something, we've never seen something like the pandemic crash before. Different. We've seen obviously crashes.
Haven't seen a recovery like that.
We haven't seen a recovery like that. And then not only did we recover, but then we went so much higher. And all of that was being driven by the Fed, literally by the Fed. And, we're giving out stimulus checks and we're doing all this. And so, now the other shoe has dropped. And on top of the other shoe dropping, you add in a war. I mean, you add in a superpower invading another country.
It's kind of like it's another catalyst. It's like if this was a swing, if SPY was a swing, like that was the catalyst. Like, yeah, we were waiting for the Fed, but also and like all the inflation and everything and just building up. But a war is like always a nice catalyst to just, hey, fuck everything.
Exactly. And so like when you look, and that's why like you look at it from one perspective and typically, the market prices in I'm gonna go out on line here and say the market usually prices in
on a line or on a limb?
On the limb. On the limb. On the line, on the limb. Yeah, on the limb. On the limb. The market usually prices in I don't want to say like warfare, but wartime, rather quickly. Like in perspective, as long as like the US isn't directly being, well, even like the Cuban Missile Crisis, what we talked about a few weeks ago, the market slipped 6%, and that was like the low. Like 90 miles off of Florida, missiles are pointed at us. We slipped down 6%, and then the market priced it in. So I really don't know. But then you got World War III. Like even before this happened. Yeah, I mean, Dan and I, for everyone that doesn't know, Dan especially loves the late night YouTube videos of like, what are the chances that like World War III happens? Oh, and this is before all this nonsense happened. And
dude,
even
like, this is I saw this is how I was so on like the Taiwan China thing with it. I'm like, fuck, dude, we don't need this. Man, I'll go into like Chinese water problems that'll lead to war. Man, I'm all over
it. Exactly. And so the chances of World War III before this happening within the next 100 years, like the percentage that it was going to happen within the next like 200 years.
Yeah, we've had a lot of a long time of peace, like in the scheme of things. I mean,
exactly. And so you add in this, and again, I don't even know how you calculate the percentage, but I mean, it drastically changes things because it's not like, you take Afghanistan, it's not just like invading Afghanistan. Okay. Obviously that sucked and that's not great and blah, blah. But you add in this component and then you start talking about World War III and holy hell, and again, yeah, like that's the thing is that, and we talked about this before, but you even take, I mean, individual names have been killed. Don't get me wrong, which we'll go into in a little bit, but you take basically what the market has done and you take valuations, like, like standard valuation, standard valuations of a company. And basically 70% of the gains pre-2019 were from buybacks and basically like companies just boosting their earnings per share and, liquidity driven buybacks. Like that's what like most of this has happened from, like it's playing poker while everyone else is playing checkers, like these they were like, even before the pandemic, these were artificial moves by companies to boost their earnings per share. Like their earnings per share were never that great. It was just because they were doing buybacks to boost their earnings per share, which allowed them to do more buybacks. We could go down this rabbit hole for hours. But my point is that if you take a traditional, I mean, we talked about this 6 months ago. Even when Tesla was at 800, like 6 months ago, even before it broke like the 1,000 or whatever it was, we were doing I had sat down and done like a regular old valuation technique. And it was like Tesla should be trading at like $40 a share. Like if you take like this traditional, yeah. But if you take like the traditional, and obviously we don't use the traditional valuation standpoint anymore, but if you do, I mean, the market should be at like SPY should genuinely be at like $90. Like I'm not exaggerating. Like I'm literally not exaggerating.
Maybe the evaluation equation's a little off.
Well, it just comes back to when everybody else was buying like Coca-Cola because Coca-Cola made, $100 million. So, $1 billion valuation seemed fine based on the multiples. Like everything's still trading at crazy multiples. Like you can't use multiples anymore. Like that's the crazy thing. I mean, I like using multiples, but
those fucking assholes on Reddit coming and fucking everything up, dude.
yeah, gamma squeezes. Like you think Papa Henny in the 1940s was using gamma squeezes?
You're telling me
no.
GameStop's not worth $500?
Yeah, like it's just like honestly, like it makes my stomach
one
turn
share
because
of
it's just
GameStop
so
was like
exciting.
worth more than what they like the income generated in a day per store.
Yeah, like that is like that's wild. Like we're playing poker. Like we're not even playing poker. I don't even know what kind of fucking game we've been playing. I don't know. But my point is that it can definitely get worse. Now, from the other standpoint, now think about this. Okay, what if the market? Let's just say Wednesday rolls around, and obviously, you guys know that I'm a long bias trader. I'm a long bias, on the market. What if the Fed only raises 25 basis points? And we start pricing in like war, and I'm not talking like World War III. I'm just talking like Ukraine and Russia kind of go through this like on their own, because again, Ukraine says that they're not really interested in being part of NATO anymore, which changes the dynamics. Obviously, there's still like the human factor, but it doesn't, if accepted to NATO, that really changes things. So them not wanting to be part of, or saying that they're not interested in being part of NATO anymore, kind of changes the game. So what if
You're
the
like,
market?
all right, I'll deal with this shit then.
But I mean, honestly, like in some capacity, that's kind of what it is, and that's whatever. And so what if the market prices that in? Because again,
It's cool to ask
Russia
for help.
Yeah, exactly. Yeah.
Don't feel ashamed, man.
Yeah, like what if we just give economic support, which obviously, we've done. But if the market starts to price in, similar to past warfare, what if the market starts to price that in, and then we only raise 25 basis points? Like that seems pretty bullish to me. That seems pretty bullish to me. And then, you've seen the Europe market. Europe market's gotten smoked. So what if money starts to, and again, this comes back to us playing poker. What if money starts flowing into US equities, because that seems like the safest place? Well, then it just comes down to supply and demand. If you don't have a run on the stock market because of 401ks, and you have people actually fleeing to US equities because that seems like the safe spot, simple supply and demand. We'll be back at all-time highs. Does it make sense? No. But again, has anything made sense in the last 60 months? Who cares if the Fed stops buying if money from outside comes into US equities?
Do you sound like a preacher right now?
I'm just saying, listen, and I'm not going to speculate.
Who's going to protect you? Is God? Is God?
Listen, and this will lead us into the lifestyle portion. It's just one of those things where it's like, there's a lot of uncertainty, and there's a lot of different avenues that we can go from here. There's a lot of different pivot points that we can go from here. Volume on the market has been extremely low.
Because it's March Madness, dude.
Yeah, exactly. That's what I was thinking.
Yeah.
All the fund managers are watching basketball,
right?
But so that's the thing, is that so the market, March 11th reversed. I mean, I think it started up the day almost a full percentage point, and we ended the day down 1% plus. So it's one of those things where it's like, on low volume, we could rip back up past that overnight.
Yeah, it just seemed like earlier in the week it was just grinding up on low volume. And now we saw it today just fucking grind down.
Exactly.
And on these and then a little bit of volume comes in, you see these crazy pops. You're like, is there news? Is there a headline? It's just
I feel like I'm searching Twitter for fucking news. Because I'm like, wait a minute. I'll be short the market. It'll start going against me. And I'm like, holy shit. Now I'm really getting smoked. And then yeah, exactly. And then then I'm like, all right, fuck it. I guess I'll go long. Overnight, we gap down. It's just absurd right now. So my biggest thing is that take this time to really think about where we're at and how many different avenues we can go down. We can get a lot worse. Or again, the thesis that I was just talking about, who knows? If Fed barely raises rates, if the Fed barely raises rates and it feels like the market's kind of priced in more uncertainty inside between Russia and Ukraine, and we start to see inflow into U.S. equities as a safe haven. Again, we'll be at all-time highs. Like, we're really not that far off all-time highs. It's more just individual names have gotten smoked.
Yeah. Yeah, and we'll get into individual names after one last question, which is, what do you think? And what's nice is that we'll be able to record on Wednesday. Actually, that's stupid. I'm an idiot. We record on Tuesday for Wednesday's episode.
Well,
we'll figure it out. So we will talk about, what do you think is the worst case scenario for Wednesday's big debut?
75 basis points. And see, the thing is that when Powell talks, usually Powell can calm the market. But when we saw him get reinstated, I think it was January, he said, I was expecting him to be like, again, super chill. Like usually he's out in the conference. He's like, we got this handle, blah, blah. And it was like, he got reinstated. And he was like, yeah, like, we got to do something about this. Like, he'd be like scared of the market. I was like, Pal, what the fuck? Like, give me a fucking heads up next time. And so it'll be interesting to see what he says during his conference, because if he says something along the lines of like, yeah, like the Fed, like, we got ourselves into a little bit of trouble, which obviously, what we just talked about, the Fed got themselves into trouble. And we have to reverse it quickly. Oh man. Oh, that could be dirty. If they raise like 75 basis points and then again, raise 75 basis points and then
over under chances on a halt down.
If that sequence happens, 75 basis points, and then he comes up to the podium and says, listen, like, the Fed realizes the mistakes that they've made, and that, we, at the time we thought that it was at the time we felt that was the best decisions for our economy, and now hindsight's 2020 and we need to reverse this quickly. Oh, but Jesus, it could get ugly. But again, the Fed is supposed to act as a balancing act. So they know that they just can't.
Anyone can hear the guys fucking fixing my shelves in my kitchen. I decided to come over.
What'd you do? Break them?
No, I moved in the 2-bedroom.
Oh, that's right.
And they like fixed all my shelves and shit or something. And they like forgot one and just brought it back. And apparently just makes a lot of noise fixing shelves. So
gotcha. Well, yeah. So effectively what I'm saying is that if the 75 basis points, like something, honestly, 50, 75, and then he walks up to the podium, and again, the Fed is supposed to act as a balancing act. So he knows that he can't come onto the podium and just scare the market. I mean, he definitely could, but he knows what that'll do to the market.
Has, yeah.
Yes. Like, he knows what that'll do to the market. So in my opinion, I don't think that'll happen. But again, prepare for the worst. I don't know that saying. It's like, prepare for the worst, get the best, or something.
Hope for the best, prepare for the worst.
That's what it is. There she is. Yes.
Okay, well, before we go into the lifestyle one, we do want to talk about like some overcrowded plays that seem like they've kind of died down a bit, to where, Jesus Christ, I don't know if y'all can fucking hear that shit. It's so fucking loud.
I can't. Really
you can't? Okay, cool.
No, not really. I hear like a little bit.
Yeah. So they just decided to really start hammering now. But so we want to talk about like some overcrowded plays that, real companies. We don't want to talk about some that may potentially just be BS, but ones that, I mean, last year you saw Fubo go on like a crazy run from what was like 8 to 60 all the way back down to 660. It's just been on one of my widgets for the longest time on a watch list. And we don't really have like a crazy list of them right now. But what do you kind of think about some of these plays that may have died or never really took off due to being overcrowded? But, now obviously they're going to be really opened up. I mean, Fubo at 660, I'm not sure about all the fundamentals, but I mean, people use Fubo. That's actually something people use. I mean, I'm not just hopping on like an old swing.
Yeah. So there's a few things that come down to this. One, I'm gonna more lean on our boy Warren Buffett. Warren Buffett's philosophy was part of his philosophy was that if he liked the product and he saw the vision, he would invest. Now that's like the most shallow layer that you can possibly go. But I like that right now. Like if for instance, Fubo and Roku, okay? Fubo and Roku have been absolutely decimated. Okay. I mean, Roku was in like the 400s.
Oh, I love Roku, dude.
Yeah. Like that's the thing. So like, if it's something where you use this product every day, and again, like you're not like you're not the only one using the product. And this thing is down huge, and you can align the fundamentals. And you can align the fundamentals. Again, this is where the fundamentals and like the valuations come in, and you see an opportunity there. I'm okay with you taking equity or leaps.
Some dude right now is listening to this and he's like, I use Wish every fucking day.
I know. See, that's the thing, is that's where like the fundamentals have to come in. And this is where like, let's not just like, go crazy and start buying like crazy leaps on things, because again, there's still like the market's only being held up by like Apple, like, some big tech.
Apple, Tesla, like all the big boys just holding the market up. And I mean, it's so obvious to see when you see them drop and what happens immediately after,
Exactly. That's the thing, is that if Apple starts to slip, in my opinion, if Apple starts to slip, I mean, it doesn't matter what the Fed says. Apple to me, in my opinion, is truly holding up the market right now. But that being said, if you want to take, again, you got to have proper risk management. You need to actually do some DD. Management team, this comes back to
because I mean, you don't want to hop in too early. I mean, if you could have seen Fubo, what is like 2 weeks ago, you'd been like, damn, it's at 10. That's pretty cheap. You wait another 2 weeks. Fuck. I mean, it's already at 6.
The way that I would handle it is that it's got to be products that I know well and use. I have to see the vision of the company, and The fundamentals have to align well, and you just have to go small. So what I mean by that is that it's okay if it's okay if you're not right for a year or two. Like, this has to be truly a long game. And these are the people where, like, obviously you need to, you're not going to turn like $2,000 into $100,000 doing this. But, if you have like $100,000, and you really see some opportunity, I'm okay with you getting long.
Dude, now, Roku is getting smoked.
It's getting smoked. It's one of the things I've been looking at.
In 3 months, 15% past a week.
Exactly. Roku's on the top of my list. And so if it's like one of those things where you use Roku, you love Roku, and I haven't looked into the fundamentals, but it's sitting at like 103. If it goes down to like 90, and you want to start buying some there because the fundamentals align, that you like the product, and you like the management team, and you see the vision of the company, I'm okay with you buying like 2% of your
$500 in July.
Exactly. And so I'm okay. And the biggest thing, there's going to be two things. One, you have to go small. So like 2% of your portfolio. Like an actual starter position. Because when I talk to people, it's like, oh yeah, I took a starter, 20% of my account. What are you doing? And then I'm actually okay with you taking leaps, as long as you understand what a leap is, and you like you still gotta have like an overall bias on the market for leaps. Like, personally, I would just go equity. So I would go 2% of my account, as a starter. And the biggest thing is that expect it to go against you. Okay. So literally, like, when I say create a plan,
this is the time you should be in a stock, and when you see a dip, not feel bad at all, because you should have prepared for it. You should have made your starter around it.
You want it to come lower, because if the fundamentals align and the vision of the company, then you're considering anything lower as a gift. Okay. And so my plan would be like, something for Roku would be, I'll start buying it at 93, and then I'll buy more at 75, and then I'll buy more at 60. And so, but all in all, even if it gets to 60 and I buy all three of those, it's not more than like 5 or 6% of my account. That is how you create really good risk management. All right. I'll go back to the .com bubble. Now, obviously Yahoo and some of your other tech companies got absolutely smoked and never came back. Okay. But if you look at Amazon was trading at $100 a share. It went all the way down to $8 a share. Could you imagine if you had bought it around then, and even let's just take Amazon. Let's just say, let's compare Roku and Amazon. So Roku was at 500, Amazon was at 100. Amazon went down to $8 a share, which would be equivalent
like 92%, over 90%.
Which would be equivalent to Roku going to like $50 a share. Okay. And so you didn't need to find the bottom on Amazon. Hell, you could have bought it at 70 and you would have killed it. But the thing is that,
you could have bought it at the top if you held long enough.
Exactly. So, and that needs to be the mindset, is that even if Roku goes down to 50 and they wipes out 92% of the gains, if you see the value in the company, you see the vision of the product in the company, and you like the management team and the fundamentals align, then I'm okay with you scaling in. But again, if that thing gets to 60 and you buy more, it shouldn't be more than 5%, maybe 6% of your entire portfolio, because that's how you create really good risk management. And then on the flip side, when it does start to go your way, you'll be okay with holding it longer, because again, you'll be okay with holding that move longer, because it won't be like every single tick is like moving your whole portfolio.
Yeah.
You know what I'm saying? So
this takes out the emotion part of it. I mean, when you fuck it, put in another account if you really want to, but it shouldn't even be affecting your portfolio enough, just like because of how much you have in there. As long as it's only 2%. I mean, these companies, as long as you picked a decent one, aren't dropping 10% a day. I mean, unless it's Roku. But, it shouldn't affect you to a point where you're like, fuck, why did I sell early? You'll hold it the proper amount of time to where you finally get your price target.
Exactly. And so that's the way that handle this, because if you handle it any other way, you'll get smoked. If you try and find bottom, you'll get smoked. So by preparing ourselves to say, I like this company, but it's going to go lower. Again, the overall move will be higher. This is the way that you can handle that risk management and handle this correctly. Now, I used Roku as an example. Another one that I really like is Disney. I told you Disney underneath 150 is a steal. I still believe that. But again, it's not going to be like, okay, like Disney's at like 120 right now. Okay. So it wasn't like, it gets to 120. It's like, let me blow 20% of my portfolio into Disney. Okay. It's got to be small increments. In fact, the way that I would handle it, if you really are struggling and maybe this is like the first time that you're doing something like this with like a long-term portfolio.
Every $5 it goes down.
I was going to say 1% every 10%, but yes. But yes, exactly. Like that's perfect, And so that's the way that you can handle this. Keep super good risk management and set yourself up for success. And if you just do that, going company by company while individual names are getting smoked, even if the market gets killed, in the end of the day, you're going to be okay. Or the other alternative, and the one that I honestly give to most people, now we are a trading podcast, but if you know absolutely nothing about fundamentals, nothing about finance, you know nothing, just cost average into the market. Just cost average into the market and use the same exact plan that we just talked about for Roku. And so this is like if you want, you can clip this part, send it to like your aunt, send it to like your uncle. The market has never not gone higher. So even if, and obviously you're not going to do this, but even if you blew your entire portfolio at 400 on SPY or on the market, then it's in your favor that you will be green eventually. Now, that being said, the way again that I would handle it is that if you just want to take your long-term portfolio and you want to just cost average in the market, every 10% that it goes down, add 10 from here, add like 5% of your portfolio. All right. Add 5% of your portfolio. So that even if the market goes down 90%, listen, you're going to cost average down, bring that basis down, and you're going to be inside a really good spot. And that's the way that you should look. When the market dips, like if SPY goes to 200, honestly, I'll probably just full net worth and just chill. I'll probably just full net worth and just chill because why not?
Not the opposite of what you're trying to say.
Well, I mean, I'm just saying that like,
bottom, dude.
Don't try and find bottom, but like I'm okay because at 200, I see the risk to reward there. You know what I mean? So like what I'm saying is that just cost average in every few percentage points and honestly hope for more downside. Like hope for more downside. You should be looking at it as it, you never do this, but you should be looking at it like this. Markets never not going higher. So any dip is a gift. Now, I'm not saying like a 5% dip. I'm talking like any crash. Anything 20% of it from all-time highs plus should be considered a dip. And that's why you cost average in. It controls your emotions, and that's how you build up so that when the market hits all-time highs, you're not just getting back to break even, but you're creating generational wealth.
All right. Well, our last section, we've got a surprisingly good amount of just those two. But our last one was going to be lifestyle. I told you I'd follow your lead on this one as I'm not too sure where we're going with this.
Well, so we talked a lot about inside this segment, we talked about individual stock picking and long-term holds. Okay. And that's fine. But, a lot of the homies day trade. And so what I wanted to talk, and we talked a lot about inside this episode about the history and kind of like what we're seeing inside the market and kind of what we've never seen before. So when I talk about that, I think it's really important. And again, I want to beat this into your heads that what we're seeing is monumental and it is history. And so with that, it can be super frustrating after the last 16 months. I know myself, I've been frustrated, I've been frustrated trading recently. And the biggest thing is that, if you're a trader and you're not killing it right now, that's okay. And the biggest thing that I think like a lot of us talk about, but this is the time to like really use that is that just keep the lights on. So manage your risk. Don't take on massive position sizes because I know that a lot of people inside the last 16 months really enjoyed it. Yeah, really enjoyed like, and again, you saw massive gains. I don't blame you.
The amount of people that I trade with that went from trading all day to now just getting like $1,400 and calling it quits you'd be super surprised. I mean, because for the past 3 months, they would try and do what they always did, just trade all day. I'll get it back. End up down like $4,000 and be like, why didn't I just quit at 10? Why didn't I just quit at 11? Why did I have to trade the end of the day? And so I'm the same way. Getting that down is I think one of the biggest things. When you realize, hey, dude, it's not my market, but I'm up now. I think that's like a big trading maturity point.
100%. And so that's where, listen, if you're down, let's just like, cause this is what I've seen a lot. If you're down like 60% on the year and you used to make, let's just call it like $2,000 a day. Okay. And now again, like Dan was saying, is that you get to 10 a.m. and you've made $300, $400, call it a day, bro.
Yeah.
Because, and this is something like
make a little bit more than you made at your last job and then call it quits.
Exactly. Like this is exactly. So like, for instance, like Thursday and Friday, the 10th and the 11th, like personally, like I'm waiting, like I haven't been trading that much. I'm waiting for next Wednesday. And so I take like 2 really good trades in the morning and I call it a day. And so it's one of those things where, let's just say that you're able to make you're able to make $500 a day. Okay. That's over $100,000 a year. The average American salary is like $52,000 a year. So you're able to make double the average American salary from
by 10 o'clock in the morning.
By 10 o'clock in the morning, you have your entire day and then you go cash. And when you go cash, you have absolutely no headline risk. You can sleep well at night. And again, okay, and obviously, I'm super privileged. I know the position that I'm in and I'm super thankful. And so like Thursday, I'm working on my pilot's license. Like that's what I've been doing inside this slower market. So Thursday I went and I flew for 2 hours. And then Friday I made a few bucks and then like nothing crazy. And then and then I went and played basketball and then I smoked a cigar out near the pier. And now I'm recording the podcast. Like that was my Friday. And did I make like if I do this every day, will I make, $10 million? No. Will I make like $5 million? No. Like I won't make anything crazy. But guess what? I'm able to do it from home. and I'm able to enjoy my Thursday and my Friday.
And the thing is, if you decide to stay in trade, you could have lost. I mean, there's always that possibility as well.
You could have lost. Or I could have made a fuck ton. Like, there's both sides. Shoulda, coulda, woulda. But guess what? If you can get into a rhythm where you're making $500 a day, and again, if you're making like $2-3 grand a day and like $500 a day doesn't sound exciting. I get it. But guess what? The alternative to not trading is going back to that job where you made 60, 70K a year, which again is still a great salary, but you go back, make 60, 70K a year, and you're working all day. So take what you can get. Yeah. This is like, I got like a little tan today. I live in New Jersey. It's fucking like 45. But guess what? I was able to spend like most of the day outside. So like make your few $100. You know, you only need like an outlier week, an outlier month of like a really good month. Like an outlier good month, and you can double your yearly profit. But don't force it.
I'm still waiting for that month this year.
Yeah, me too. And remember, okay, we're only through Q1. Okay, so don't try and make it back. If you're down 60%, guess what the good thing is that let's just say you're down 10 grand. Well, now you have 10 grand to make back that is not going to be taxed. Like, think about it that way. You know what I mean? Now, whatever your starting point is, if you're down, everything from here on out is basically tax-free because you're just making it back. So count this as like your ground zero. Okay? If you're inside like 30% tax bracket, okay, every $1,000 you make, $300 usually goes to the government. Well, if you're down 60% and you're down, 40 grand, guess what? You got 40 grand tax-free. Like, that's the way that you need to look at this. And then you also need to say to yourself, I'm not going to make this back by June. I'm not going to make this back by July. Okay, this is going to be a 2-year process. But guess what? You get consistent and who cares? Who cares? You make 100 grand. You make 50 grand. You're able to make the average American salary inside your pajamas, and you don't have some work boss. You don't have you don't have a bunch of pointless meetings every day. That's a huge win. How many people I don't know a single person that if I said to them, hey, I'll give you your salary if you sit in front of a computer for 6 hours a day, but you don't have to do any meetings. You don't even have to talk to anybody if you don't want to talk to them. And you make your exact salary. And guess what? Once in a while, you might get a bonus because you have a good week. You just got to manage your risk. Who wouldn't take that? Like, understand the opportunity in front of you. I feel like I'm beating a dead horse, but
you done?
You get what I'm saying. Because I've seen too much of this. Like, I'm down 60%, I want to get back. And I get it. But it's not going to happen. It's just not. Like it's just not going to happen. So take this as your ground zero. Look at the money that you lost as basically tax-free money until you make it back. And take those wins. And guess what? You make $500 by 11 a.m. Go enjoy your day. Like, no, you can't go, you can't buy that Porsche because you're not making $3 grand a day anymore. Sorry, I feel like that was at you.
A little personal,
So the thing is that, that was personal. But the thing is that, like, no, can you buy that, like, maybe you got to return that.
Jesus Christ, dude, come on, just say it.
Like, maybe you got to return that watch. Maybe you can't go and buy, something stupid. Maybe you can't spend $5 grand on some vacation.
Anything
but
else?
But guess what? Yeah, I know.
No,
maybe you gotta take off that cast. Yeah,
you can't get $3 grand surgeries and then $3 grand bone stimulators.
Hey, so guess what? Take out the old budget that you used to use and handle it that way. Like, I get it. Like, you're down 60%. You want to make it back tomorrow.
But I'm not down like 60%, right?
No, you're down like 80, right?
Fuck off. I'm down like 12.
No, and that's fine. Like, I think I'm down this quarter too. Like, I got a random IRS tax bill in February. And I was like, and for 6 figures from 2020, and I had 2 weeks to pay it. And I was like, holy shit, like this now makes me down for the year. And so it's one of those things where it's like, all right, make your $500, make your $1,000. And so no, no, you're not going to be like the top 1%. Who the fuck cares? You're doing it from home.
All right.
I feel like I've really beat the dead horse, but like, you get what I'm fucking saying.
All right, guys. Well, it is St. Patrick's Day when you're listening, if you're listening when it comes out. So let's make sure we're green for the rest of the month and hopefully the rest of the year. Anything else you got, or you good?
No, I'm sweating.
Okay, good. You seem like it. All right, guys. Well, make sure to 5-star, like, subscribe everywhere. You know the vibes. We love you guys, and we'll see you on Wednesday after the Fed thing. Good luck.
Pennies Going in Raw is a production of iHeartRadio. For more podcasts from iHeartRadio, visit the iHeartRadio app, Apple Podcasts, or wherever you get your podcasts.